Hey guys, how's it going? It's Charlie Marr, and today I want to talk to you about buying too soon. It's something that is completely normal, and I want to help rewire your brain to make you feel that it's okay and that it happens. It's normal. You get used to it as time goes on and the more it happens. But yeah, it's something that I'm always preaching about. I'm always telling you guys that it's okay for stocks to go down. It doesn't bother me. For me, most of the time when I buy a stock, I kind of already have that expectation. I know I probably didn't catch the perfect bottom. So I'm already mentally prepared for the stock to go down. And I even envision and see where my money will head when it's down 10, 15%. Maybe that's why I feel easy, Anyways, for me, it's natural. I'm used to it. It's normal. But for you, it might not be. So I'm here to help rewire your brain and to make you understand it's okay and normal. So I want you to avoid these mistakes. Now, like I said, why hear it from me when you can hear it from top value investors? I'm going to show you 3 videos. They're very quick. But these guys are multi-billionaires, and one of them has hundreds and hundreds of millions of dollars. We're talking about mega filthy rich people. Multi-generational wealth type of rich. Anyway, so let's go ahead and get right into it. The very first person is Monish Prabrai, and let me go ahead and share this video to you guys, and then I'll make my commentary afterwards. So let's go ahead and listen in.
Is one position, but one of the things that always happens to me, but it only happens to me, it doesn't happen to you, is every stock I buy goes down first. And it always goes down. I don't know why it doesn't go down before I buy, but they all go down after I buy. Somehow it knows. And Bruce Berkowitz is a fund manager. He calls it premature accumulation. So I always have premature accumulation. And
That is the first video. That's Monish Prabrai talking about him buying too soon, and he even makes it sarcastic, it only happens to me, but it doesn't happen to you, because that's how you feel. That's literally how people feel when they're buying all these stocks. They're like, why does it always go down after I buy? I feel like a magnet. Every stock I buy goes down first. Well, first of all, let me tell you, you're not the center of attention. I'm sorry to break it to you, but you're not. And the other thing is, the stock doesn't know about you, doesn't care about you, it doesn't know you exist, it doesn't know anything. You are irrelevant. So the stock doesn't know you're buying. So for you to believe that, just because I buy a stock, it has to go up, and to think and have this vision of you catching the perfect bottom is quite honestly cringy and hysterical. You're not perfect. You're not going to catch the perfect bottom. And the thing is, you have to remember, especially when you're value investing and being a contrarian, because you're buying stocks when they're distressed, when everyone is selling them, when everyone's trying to get rid of them, when nobody wants them, people are fearful, there's news going around, they're targeting it, they're downgrading it. So of course, if a stock crashes from 10 to 4 and you start buying, what makes you believe it's just going to turn around and go from 4 to 5? It'll continue its downtrend. You're buying in a downtrend. You're catching a falling knife. It'll probably go to $3.50, $3. You have to get used to that. But if the value is there and you know what it's worth, there's nothing to worry about. Double down, buy more, Anyways, that's the first one, Monish Prabrai. He even talks about it called premature accumulation. Pretty funny. Anyway, so that's the first one. Let's go on to the next video. Let me show you the next one. This is Bruce Berkowitz. And it starts off a little bit low, but the volume will get up. Hopefully you guys are able to hear.
I had 2 companies in the entire portfolio. Again, Fairhome's not changed since its first date. We focus on our best ideas. We're long-term oriented, and I clearly have a history of buying too soon and selling too soon.
One last question for you. You've told me before that diversification is dumb. Why own your 5th best or 6th best idea when you can own more of your very best idea or your 2nd best idea?
Okay, so that is the end of that video. Again, they're really quick videos, but what did he say? What did he just talk about? Buying too soon. He said, I have a clear history of buying too soon. And what did he say? What did he follow that with? Of selling too soon. That is the other side of the spectrum that you have to get used to. And that happens all the time. It happens to me. I buy a stock, I buy it too soon. I bought a stock at 22 cents. This is a real trade, investment, I should say. It went from 22 cents to 11 cents. I was down 50%. The stock ended up running to $7. Now, of course, I didn't sell at $7. But I sold it too soon. And that's normal. That's another thing you have to get used to. So you have to get used to buying too soon and the stock tanking on you a little bit and dealing with it. And then you're going to get used to when you sell it, because it becomes overvalued, that it could continue going. So you end up selling too soon. You're not here to be perfect. You're not here to throw darts at a board and speculate. Why would you speculate? Why would you estimate and assume and hope and pray that things go different? I always tell you to keep it simple. Buy when the value is there. Don't overthink about it. If it's worth $5 and you want to buy it under for a 50% margin of safety and it's at $250, $249, $239, buy. The value is there. Stop trying to see if it'll go lower and to see if you can catch it lower, because then what ends up happening is you don't buy it and then it bounces. But then if you buy it and it goes down, you're hating yourself. So you're always going to be hating yourself. You're always going to be thinking of the best case scenario, the could have, should have, would have. I could have made this. I would have made this much. I should have waited. You're always going to think of the perfect scenario. Now, the other thing he said at the very end was diversification, that he thinks that diversification is dumb. That's something that I'm always preaching to you guys as well. Why would you... If you really know your investments and you rank them all, why would you invest on your 7th, 8th, or 10th one, or even your 5th one, really? Like, why don't you focus on your best ideas? And he told you that. I mean, it's what he does. That's something that I talk about. Diversification is protection against ignorance. If you don't know what you have, what you own, you diversify. If I didn't know what I was really holding, I would diversify. I would buy like 20 stocks just in case I'm wrong in one of them. But when you really understand the value, you don't have to do that. And the crazy part about this is, which I will have to make another video of this, is that even when you're wrong on that time and you do take a hit, because you're buying $1 for 50 cents, you're aiming for those 3-time runners, it offsets the losses. So you can literally lose like 3 times or twice and have one winner, but that winner tends to overcome the losers, and you always stay on top. That's a whole other topic. Anyways, let's go on to the next video. This one's going to be a little bit longer, but it's also a great video. Let me move this one out of the way here and go on to the next one. This is John Templeton. Let's go ahead and play this video. I don't know where to put myself on this one. I'm just going to put myself here. Sorry if it gets in the way.
How can you run a couple of $1 billion worth of investments from a surrounding like this? Don't you have to be on Wall Street?
We did move here because it is so very pleasant. But we now have found that in the 22 years we've lived here, the performance of our mutual funds is better than in the 25 years we were managing them from Radio City in New York.
Well, how do you account for this? I mean, you could work at Radio City and do things differently.
Yes, we tried to, but we go to the same meetings as the other security analysts, and the people who speak are so sensible that we can't help being influenced. It's much easier to be odd when you're 1,000 miles away.
Trying to be odd, going against the herd, has been a Templeton trademark as he searches for bargains that others have overlooked.
That is super important. Man, all these things are important. I'm going to keep saying that. Is staying away from all the noise. I mean, you just heard him. He performed better when he left New York, when he was no longer where all the trading and high activity and all the like firms and everything was. He started to perform better. And he said it himself, because if he stayed there, he would be influenced. And that's something that we all fall into it. I fall into it all the time because I go on Reddit or mess around sometimes. Like I even fall into some little things, you know, and I get influenced like, oh, maybe I should kind of bet on this or do dumb things, you know, but that's why it's important to stay away from all the noise. And if you really want to rewire your brain and stay away from that, I highly suggest you get off things like stock tweets. You stop checking things on Twitter. You're careful on what Discord groups or Telegram groups you join or what other groups, courses, or mentors you join, because if you're surrounded by it all the time, you're going to be influenced and you're going to be looking at the same stuff. You're going to be performing the same. Remember, there's a 1% for a reason. If you want to be on the top 1% or if you want to be a successful investor, you have to do what 99% of the people who are always failing aren't doing. And I mean, this is going to go into the second part where it goes into being a contrarian. So this is also a great thing. It's buying things when nobody's paying attention to them. And speaking of the last thing, I mean, you saw stocks go down. Look at what happened with Charlie Munger and with Monish Prabrai and with me right now with Alibaba. The stocks are down. We're buying more as it goes down. We feel fine and comfortable and could go to sleep just fine. Anyways, So you're buying stocks when they're distressed. That's the whole point, the whole reason why they go down after you buy. And that's something that John Templeton is about to talk about, is buying stocks when nobody's paying attention to, buying stocks when everyone's being fearful, when nobody wants them, when everyone's laughing, when it's being downgraded, when it's falling, when the downtrend's nasty, when everyone's talking shit, when there's a bunch of bears, everyone's being fearful, they're panicking, they're worried, they're rethinking everything. Let's go ahead and listen to the rest of it.
How do you know? You've always said that you should sell when the herd is happiest and buy when it's gloomy. How do you know when the herd is gloomy that it isn't right?
Sometimes they are. And of course, we make hundreds of mistakes all the time. But we have found, from the very time we started our investment council operation 44 years ago, we published as the motto of our business to buy when others are despondently selling, and to sell when others are avidly buying requires the greatest fortitude and pays the greatest reward. Now, this applies not only to stock market cycles, but it applies to particular industries and types of stocks. Basically, we determine that by finding out what is selling at a depressed price. If a stock is selling for a quarter or a half of what it's worth, then it is a bargain and is, in most cases, unpopular with other investors.
Mainly, you like to buy companies that are out of favor. For example, I noticed that your biggest position is in Royal Dutch, but everybody's expecting oil prices to go down.
What he was saying there was that, like, how he's buying oil company, you know, and that everyone's expecting it to go down. Anyways, I'm going to repeat myself, you know, but listen to what he said himself. I mean, he's a contrarian investor. He's buying when the stock is not in favor, when everyone's selling and panicking, you know, when everyone's talking crap, when there's news going around. And he started buying this oil company, the Royal Dutch, I think is what it's called, from the energy sector, when everyone was expecting for oil stuff to crash and go down. Look at where oil is now. Look at what's happened to oil. It's literally going to, and it will peak again. Oil will head to highs again, and it's much higher than it was back then when this video was made. So again, it's that contrarian mindset. So the three things on this video that you should take away is, number one, sorry, I was checking how many minutes we're in. Number one, you're going to buy too soon. A stock is going to go down when you first buy it, and it's okay. And one of the biggest mistakes you can make is constantly switching that. I don't know if I already mentioned this in the video, but I'll say it again just in case I haven't. The biggest mistake you can make is when you buy a stock and it goes down and you are panicking, you sell, and then you go on to the next one. And you're panicking and you sell because you're down 10, 15%, and you go on to the next one. And you get pitched a new stock and a new hype, and you get hyped about a new stock, and you were reading into a company and like you feel confident about it, and then it goes down. Before you know it, you bought and sold 4 stocks, 3 different stocks, and all you did was lose money. And then you look back a couple years later, or a couple months, or a couple weeks, and you realize if you just held one of them, any of them, either one of them, you would have been up a lot more, or profitable, or killing it in the market if you just held one of those. And it's something that we see happen all the time. You've seen me do this live. You've seen it happen to me. People have made fun of Funko and Charles and Covard and G3, you name it. And then they look back and then they realize if they just held those stocks, their portfolio would be higher than all the things they've been doing. Then when options and high activity and this and that and trying to chase in crypto, and then you compound when you do it the second time. So that's the first thing, right? Is buying too soon. Selling too soon is also going to happen. It's going to be common for you to sell a stock too soon. I say keep it simple. Buy when the value is there, sell when it's not. And the third thing is it's being a contrarian. Buy stocks that nobody's paying attention to, when they're unfavorable, when they have bad news. And we've talked about this, how to buy stocks and how to know when to buy them, you know. It's a whole different video. But anyways, that's it for this video. I hope you understood these 3 lessons. But yeah, I will see you guys on the next video.